Hi, this is Solomon with the Mortgage Hub, and I wanted to talk briefly about impounds or escrows on a mortgage, when they're required, when they're not required, should you opt to have them, what are the pros and cons, what my opinion is on it. So, just in general, impounds and escrows, it's the same, it means the same thing, just a different word for the same thing. And basically, what it means is it's the savings account that you're keeping with the lender, where monthly, when you pay your monthly mortgage payment, you're also paying 1/12 of either your taxes or your insurance. That goes into that account. The lender keeps that in that account. It accrues in that account. When those payments are due, the lender uses those funds to pay your taxes or insurance. There's always going to be a little bit of a buffer, a reserve on top of what they actually will need in that account. How those amounts are calculated, it really is as simple as it's a complicated, I guess it could be a complicated calculation, but the basics of it is like, how many payments do you have from your first payment until those either taxes and insurance are due with the county or the mortgage company, or the insurance company. So how many payments you have until those payments are due, taxes or insurance, and while keeping always at least a 2 to 3 month reserve, typically 2-month reserve in that account at all times. So that calculation, as you can see, is going to vary depending on how many payments you have, when those taxes and insurance are due. Obviously, the insurance is due once a year, but the taxes can be due, depending on state, twice a year, 4 times a year, once a year, and when they're due. So, and then how that relates to your payment, or when your first payment date is. So again, that calculation will vary. If you have any questions on your specific state, please reach out. But that's how that calculation is done. So if we take a look at, let's say you're looking at your loan estimate, which I have in front, a sample here in front of us. Take a look at section G right here, goes over that's the impound or escrow account. So what in this example, they're collecting 3 months of taxes and 3 months of insurance. And in addition to these 3 months of insurance, because this is a purchase transaction, there's also 12 months of the homeowner's insurance collected. So they're collecting 12 months of homeowner's insurance plus a 3-month reserve. Okay, the 12 months, why, is because when you close on the purchase, which this is, we have to make sure that the full year of insurance is paid. And then every month when you're making your payment, it accrues in what would essentially be this account that's kept with the lender, this escrow account. And then every month you're going to add to this 3-month reserve. And then next year, when your insurance is due again, there's often there to pay another full year while still keeping a reserve of at least 2 months. Okay. Property taxes, same kind of logic there. 3 months. Okay. And again, it all depends on when you're closing, which state you're in as far as when they're paying your taxes. But let's say in this case, California, they're going to be paid in either November, December, and then March, April. They're going to be late by April 10th, late by December 10th. So they're going to be paying that month or slightly before then. Okay. So this being a purchase transaction, as a sample here, with a March 15th closing, you're going to have your first payment be May. So you're going to have May, June, July, August, September, October, and then in November, you're going to be paying them. So that's what I mean with the amount of months from your first payment until when the first tax installment is due in California. So we'll need it to collect 3. The later you close in the year, this number here is going to go up because you have less payments remaining until the first installment is due. Okay, so that's that section right there as far as when they're required. Generally, if you are going to be putting down 20% or more, or the equivalent, if you have an 80% loan of value or less, then you can waive or exclude impounds or escrows. Now, there are going to be differences there. In California, for example, you can, generally go all the way up to 90, 95%. Some lenders will allow it all the way to the 97% loan to value, and there are going to be some exceptions to that in other states as well. For example, in the state of Texas, it's 20%, generally 20% down or more, or 20% equity or more. But then there are going to be some lenders that are going to allow even Texas all the way up to 95, 97%. So, but as a general rule, 20% down or more, so 20% equity or more. As far as, what's my opinion as far as, should you take them or should you not if you have the option? I always believe that I'd rather manage those impounds myself. Okay, I'd rather just open up a checking account with my preferred bank. Every month I put, my portion of the taxes and insurance in there, let them build in there, and then I have control of it. I get the bills from the mortgage, from the insurance company or from the tax authority, right? And then I use those funds in those accounts to pay it. That's essentially what it is. But having the control, I like that better. On top of the fact that I've seen plenty of times, especially in California, where there is a lag on when the county changes or reassesses the property. Okay, typically a year lag when the system or the county records are updated. So in between that, you have to be really careful about making sure that the certain mortgage servicer is paying the supplemental tax bills, for example, in California, because since in California you're going to be a lag between the time that the county records are updated as far as the property reassessed on the new owner. They're going to supplement that with supplemental tax bills. So you're going to be responsible for the supplemental tax bills, making sure you get them to the servicer and making sure that they're paying it. Otherwise, you're going to have delinquent tax bills. So for that specific reason, I've seen problems in Texas as well where you're buying from a builder, and so there's issues there potentially that you definitely have to stay on top of. Okay, so for that reason, I like to, if I have the ability to handle that myself, I'll do that. Even I say for folks that say, well, I just want to make the payment, don't worry about it, just I want to make my monthly payment to the mortgage company, let them handle it. Even in that case, if you prefer that, that's fine, but I would still highly recommend you keeping tabs of exactly how that's managed. If you get anything in the mail, either from your mortgage or from your insurance company or from the tax authority, to if you have any questions, call your mortgage company, call your loan officer, your broker, etc., and make sure that it's handled correctly, right? So it's not a set it and forget it type thing, in my opinion, right? I see plenty of problems with it. So that's my opinion on impounds. So all in all, I say if you can avoid them, well, personally, if I can avoid them, I will. But obviously, you got to make that decision. As far as what happens at closing, they're just going to be on your closing disclosure. They're going to be initially on your loan estimate in Section G, or on your closing disclosure. So that's what that is. If you have any questions on why are they taking that many months, I'll reach out to your mortgage company, your loan officer, and go over those details. But all in all, the bottom line is that impounds or escrows is just one way for your mortgage company to make sure that the taxes and insurance are paid. Okay, so that's it. If you have any questions, please feel free to reach out. I'll be happy to help. Thanks.